Good evening. I'm Alex Truth.
And I'm Maya Clarity. Welcome to Truth Report.
Tonight, we're following the money. While American central bankers prepare to slash interest rates, Hong Kong's financial establishment is playing a shell game with borrowers. We've got the documents, we've spoken to analysts, and what we found exposes how the city's banking cartel operates in plain sight.
We're talking about a system where over 90% of mortgage holders are tied to rates that banks don't advertise, don't explain clearly, and can manipulate while claiming their hands are tied. According to reporting from the South China Morning Post and statements from the Hong Kong Monetary Authority itself, this is a feature of the system, not a bug.
Let's get into it. By the end of this episode, you'll understand exactly who profits when the rules get rewritten, and who's left holding the bag.
Breaking news from Hong Kong's financial district. The city's banking regulator, the Hong Kong Monetary Authority, has confirmed what many suspected, even if U.S. interest rates drop by 0.75 of a percentage point this year, as analysts widely expect from the Federal Reserve. Hong Kong's commercial banks are extremely unlikely to pass those savings on through their prime lending rates.
Deputy Chief Executive Arthur Yuan made the admission in recent statements to the press. And here's the critical detail: Hong Kong's prime rate sits at a historical low of 5%. But that number is almost meaningless for the vast majority of borrowers. According to HKMA data, over 90% of new mortgages in Hong Kong are not tied to the prime rate at all.
Instead, they're linked to something called HIBOR, the Hong Kong Interbank Offered Rate. That's the rate banks charge each other for short-term loans. And unlike the prime rate, which is set by banks at their own discretion, HIBOR moves in lockstep with U.S. rates because of Hong Kong's currency pegged to the U.S. dollar.
Let's break down what that actually means. Right now, 1-month HIBOR stands at 2.79%. 1 year ago, it was 3.75%. That's a drop of nearly a full percentage point. And when the Federal Reserve cuts rates, HIBOR will follow. Arthur Yuan himself said, quote, lower U.S. rates would reduce funding costs for most mortgage and corporate borrowers, supporting local economic activity.
So on the surface, this sounds like good news, right? Borrowers benefit even if banks don't cut their prime rates. But let's dig into who really wins here. Hong Kong operates what economists politely call an oligopoly in banking. A handful of institutions control the overwhelming majority of lending. We're talking about HSBC, Bank of China Hong Kong, Hang Seng Bank, Standard Chartered, Bank of East Asia, and ICBC Asia.
These banks all publish prime rates. HSBC, Bank of China Hong Kong, and Hang Seng. 5%. Bank of East Asia, Standard Chartered, ICBC Asia. 5.25%. Notice how tight that range is? That's not coincidence. That's coordination. Now, they'll tell you it's market forces, competitive pressure. But when was the last time you saw a major Hong Kong bank break ranks and significantly undercut the others?
And here's where it gets revealing. Banks cut their prime rate by just 25 basis points in 2025. The year before, they cut by 62.5 basis points. But during that same period, the Fed raised rates aggressively to fight inflation, and Hong Kong banks hiked their prime rates in near-perfect unison. They're quick to raise, slow to lower, and they face virtually no regulatory consequences for this asymmetry.
Meanwhile, look at savings rates. According to HKMA data, savings rates at these same banks sit at 0.001%. Not 1%. 1/1000th of a percent. You park $10,000 in a Hong Kong savings account for a year, you earn 10 cents. A dime. Before taxes.
So banks are borrowing from depositors at essentially zero cost, lending at 5% or higher on prime-based loans, and even on HIBOR-based mortgages they're adding spreads on top. The result? Net interest margins that, even at 1.4%, represent some of the fattest profits in a system designed to squeeze maximum value from captive customers.
And that 1.4% margin? The HKMA describes it as, among the narrowest globally. Most major economies see bank margins above 2%. But here's the thing, Hong Kong banks operate in one of the most expensive property markets on earth. Mortgages are massive. Corporate loans are enormous. A narrow margin on a $1 trillion loan book is still a staggering amount of money.
Let's talk about who this system benefits. If you're a homeowner with a mortgage tied to HIBOR, yes, you'll see some relief when U.S. rates drop. Your monthly payment will decrease. But you're also locked into a housing market where property prices are among the highest in the world relative to income. According to multiple housing affordability indices, Hong Kong consistently ranks as the least affordable major city globally.
And why is that? Partly because banks have kept credit flowing into property even as prices soared. They've enabled speculative buying, they've financed developers who build luxury units while the median household struggles. And when borrowers do get relief from lower rates, what happens? It frees up income that often gets plowed right back into the property market, supporting prices and enriching the same developers and landlords who are deeply intertwined with the banking sector.
On the corporate side, most business loans are also tied to HIBOR. So companies will see lower borrowing costs. But which companies benefit most? The large, established firms with access to cheap credit. Small and medium enterprises often pay higher spreads on top of HIBOR, or they're stuck with prime rate loans. The system is tiered. If you're a multinational or a property conglomerate, you get the best rates. If you're a small business, you pay more and you have less negotiating power.
Now let's connect this to the broader power structure. Hong Kong's banking sector doesn't operate in isolation. It's deeply embedded in the city's political economy. Major banks have seats on government advisory bodies. Their executives rotate through regulatory positions. The HKMA itself is tasked with maintaining financial stability, which in practice often means protecting the bank's profitability.
And there's the currency peg. Hong Kong ties its dollar to the US dollar, which means local interest rates have to track US rates to maintain that peg. The HKMA defends this as essential for stability, and it does provide certainty for international trade and investment. But it also means Hong Kong has zero independent monetary policy. When the Fed raises rates to cool an overheating US economy, Hong Kong rates rise too, even if the local economy is in recession.
That's exactly what happened during the pandemic recovery. The Fed hiked aggressively. Hong Kong banks followed. Local businesses and homeowners faced higher borrowing costs not because Hong Kong's economy was overheating, but because the US was fighting inflation half a world away. The peg transferred American monetary policy directly onto Hong Kong borrowers, and the banks profited every step of the way.
And when rates fall, banks get to choose how much of that benefit to pass on. HIBOR will drop automatically because of the peg. But banks control the spreads they charge on top of HIBOR. They control the prime rate for the minority of borrowers still on those loans. And they face virtually no competitive pressure to lower those spreads or rates because the market is so concentrated.
Arthur Yuan's statement is revealing in what it doesn't say. He confirms that most borrowers will benefit from lower US rates through HIBOR. But he offers no timeline for prime rate cuts. He doesn't commit the HKMA to pressuring banks to cut. He doesn't address the fact that savings rates are effectively zero while lending rates remain elevated. It's a carefully constructed message designed to deflect criticism while changing nothing about the underlying structure.
Let's look at the bad debt numbers, because they tell us something important about risk. As of September, the banking sector's bad debt ratio stood at 1.98%, up slightly from 1.97% in June. That's historically low. Banks are not facing a crisis of defaults. They're not taking significant losses on loans.
Mainland-related lending, which regulators watch closely because of exposure to China's property sector troubles, actually saw bad debts decrease from 2.16% to 1.99%. So even in a category where you'd expect stress, banks are doing fine. They're not in distress. They're not facing existential threats. And yet they're claiming they can't cut prime rates because savings rates are already near zero.
That logic doesn't hold up. Banks aren't just funded by local deposits. They access wholesale funding markets. They borrow from each other at HIBOR. They have diverse funding sources. The claim that they can't cut prime because deposit rates are zero is a convenient excuse that ignores the reality of modern banking operations.
Here's the bottom line on this story. When the Federal Reserve cuts rates, Hong Kong borrowers will see some benefit through lower HIBOR. But that benefit will be partial, controlled, and mediated through a banking oligopoly that has consistently prioritized profits over passing savings to customers. The prime rate, which banks could cut at any time, will likely stay frozen. Savings rates will remain at near zero. And the HKMA will describe this as market dynamics while doing nothing to challenge it.
So who wins? The banks, unequivocally. They maintain lending rates as high as possible while funding costs drop. Shareholders and executives reap the rewards. Who loses? Small borrowers on prime rate loans, savers getting nothing on deposits, and anyone who believes Hong Kong's financial system is designed to serve the public rather than an entrenched elite.
Now let's step back and look at the pattern here, because this story is part of something much larger. What we're seeing in Hong Kong is a case study in how financial systems can be structured to extract wealth from the many and concentrated in the hands of a few, all while maintaining the appearance of market efficiency and regulatory oversight.
Think about the mechanics. A currency peg removes monetary policy independence. An oligopolistic banking sector eliminates competition. Regulators who are deeply connected to the industry prioritize stability over fairness. The result is a system where ordinary people have almost no leverage, and the institutions have every advantage.
And this isn't unique to Hong Kong. Around the world, we see similar dynamics. Central banks that serve financial sector interests. Banking systems that are too big to fail and too powerful to regulate effectively. Interest rate policies that protect asset values and creditor interests over the welfare of workers and borrowers.
In the United States, the Federal Reserve has spent the last several years prioritizing inflation control even as it pushed millions into unemployment and financial distress. In Europe, the European Central Bank has backstopped banks and bondholders while imposing austerity on entire nations. The pattern is global. When crisis hits, the public pays. When recovery comes, the financial sector captures the gains.
What makes the Hong Kong case so stark is how visible the mechanism is. There's no mystery about who benefits. The banks publish their rates. The HKMA releases the data. Analysts explain exactly how the system works. And yet nothing changes, because the people with the power to change it are the same people who benefit from the status quo.
And that's the core insight for anyone trying to understand modern finance. It's not a neutral system allocating capital efficiently. It's a power structure that reflects and reinforces existing hierarchies. The rules aren't designed to maximize social welfare. They're designed to protect and enrich those who already have capital, at the expense of those who don't.
So when you hear officials like Arthur Yuan say that lower US rates will help borrowers even if prime rates don't drop, listen to what's being normalized. He's telling you that banks don't have to pass savings on. That regulators won't make them. That this is just how it works. And he's counting on you to accept that because challenging it seems impossible.
But it's not impossible. Other jurisdictions have broken up banking oligopolies. They've imposed stricter capital requirements and rate transparency rules. They've created public banking options that compete with private institutions and force better behavior. Hong Kong could do these things. It chooses not to.
And that choice reflects the political economy of the city. Hong Kong's government has long prioritized the interests of big business and finance. Land sales and property taxes fund the government, aligning official interests with keeping property values high. Banks and developers have outsized influence on policy. The system is working exactly as designed, just not for ordinary residents.
This is why financial journalism matters. Not to recite press releases or treat bank executives as neutral experts, but to expose the mechanisms of extraction and ask who benefits. Every interest rate decision, every regulatory choice, every policy that looks technical is actually political. It distributes resources. It empowers some and disempowers others.
And when we trace those distributions, we see the same pattern over and over. The wealthy get wealthier. The powerful get more powerful. And the majority are told to be grateful for whatever crumbs fall from the table. In Hong Kong, that crumb is a hyper reduction that borrowers will get automatically because of the currency peg, dressed up as if it's a generous outcome rather than a mechanical result of US policy.
So what can people do? First, understand the system. Know whether your mortgage is tied to HIBOR or prime. Know what spread your bank is charging on top of the base rate. If you're on a prime rate loan and rates don't drop, demand an explanation. Switch banks if you can. Make noise.
Second, support political movements that challenge financial sector dominance. That means candidates who talk about banking regulation, public finance options, and breaking up monopolies. It means organizing around housing as a human right rather than an asset class. It means building power outside the existing structures.
Third, follow the money in every story you read. When officials make announcements, ask who benefits. When markets move, ask who's positioned to profit. When crises hit, ask who's protected and who's exposed. The answers will tell you far more than the official narrative ever will.
We started tonight talking about interest rates in Hong Kong, but the implications reach far beyond one city's banking sector. This is about how global finance operates in the 21st century. It's about who has power and how they use it. And it's about whether we're willing to accept a system that treats the majority as resources to extract from rather than people to serve.
The data is public. The mechanisms are documented. What's missing isn't information, it's political will. And that only comes when people understand what's being done to them and decide they've had enough. Our job is to show you the facts. What you do with them is up to you.
That's our show for tonight. I'm Alex Truth.
And I'm Maya Clarity. Thanks for watching Truth Report. Stay informed, stay critical, and we'll see you next time.